Hello everyone, welcome back to another dividend investing video. As dividend growth investors, we seek out companies that have an established history of stable and increasing dividend payments to build passive income. But it's important to understand the risks involved with investing in individual stocks and that dividends are never guaranteed. Dividend cuts are possible. In today's video, I want to look at a couple companies where their stocks where the dividend has either been cut or is in a real danger of being cut. And I will show the signs to look for, and most importantly, the steps we can take as responsible dividend investors to protect our passive income and portfolios. I have a warning about one stock in particular, so let's do this. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. One thing we focus on as dividend investors is a company's track record of paying and increasing its dividend, and we're making an educated assumption that this will continue based on some fundamentals. But it won't always be the case. Even dividend aristocrats, these are companies that have raised their dividend for 25 years, and Dividend Kings, and that's a company that's raised its dividend for 50 consecutive years, can and do cut their dividends. Unfortunately, a company can find itself in such a position where their best option for the business is to cut or eliminate their dividend. In fact, one Dividend King just lost its status recently, and that is VF Corporation, ticker VFC. They are a clothing apparel company, lots of outdoorsy brands like Timberland and North Face. You've certainly heard of one of their brands at least. On Tuesday, February 7th, 2023, VFC announced a 40% cut to their quarterly dividend, down from 51 cents per quarter to 30 cents per quarter. Looking at their position, this was probably the right decision by management, and the stock was even up 1% after hours on the news. Before the cut, shares of VF had fallen dramatically, so dramatically that it was yielding over 7%. And look at these payout ratios. This combined with that rising yield was a sign of some trouble. The prior dividend was set to make up 95% of forward earnings. And look, even with the cut, this stock is still yielding 4.21%, still far above its 5-year average yield of 2.5%. So if I was invested in VF, which I'm not, I probably wouldn't be too upset with this, but then again, I'm also not someone who relies on dividend income to pay my bills. I'd likely be more annoyed with the over 50% drop in share price over the last year. And let's look at what's happened. They're calling this a shifting of resource priorities, and are also exploring selling off some of their non-core brands. They're even considering a sale and leaseback of their European headquarters in Switzerland. This dividend cut is going to save VFC about $225 million and let them redirect some additional capital towards their debt as they aim to hit their target leverage ratio of around 2x, and currently it's at 3.37x. Management says they will increase the dividend with earnings from here, so with this cut and shares yielding over 4%, this could be a decent time to get into this one for new investors despite this recent cut. I think the valuation looks attractive here, assuming they're able to return to their historical averages if things can improve. But that's VFC, Dividend King no more, and I certainly feel for anyone who is buying this and relying on it for income. So as investors, we understand that no investment is completely risk-free, but here are some steps that we can take, right? First, if we're going to invest in individual stocks, like I do, we have to stay up to date on the financial health of these companies. We want strong financials, high earnings, low debt, a sustainable payout ratio on both earnings and free cash flow. A dividend that is easily covered by free cash flow is a dividend that is sustainable. Second, we want to diversify. You don't want to put all your eggs in one basket. I started building up a portfolio specifically for this channel, and if you've watched my videos before, you're probably familiar with it. Here it is. I've started it from nothing about 4 months ago, just adding small consistent contributions every week. And I've been buying into 24 different dividend stocks, as well as 3 ETFs. And some might think this is too much, but the idea here is I have 24 different companies paying me. If one of them cuts its dividend, yeah, it's going to hurt, but it's going to hurt less than if I invested in 5 or 10 or 12 stocks, you see. Of course, you want to pick quality companies with solid financials, and the more you own, the more you have to track. So there is a balance you want to maintain. And this brings me to my third point, investing in broad ETFs. These are essentially baskets of stocks. With the popular SCHD, you have 3% plus yield and double-digit dividend growth historically. And then there's VYM. This pays a nice yield as well. Not quite as impressive on the dividend growth, but with over 400 holdings, one dividend cut is barely going to move the needle here, right? And then you have VOO. This is an S&P 500 index. It yields a little less at 1.5%, but with this you're getting market returns, and that 1.5% is going to be very reliable. Now, putting a good portion of your money into these types of investments, I believe, is a wise decision. In this portfolio, I'm going with about 30%, and I'd probably make it higher, but look, my entire 401k is in the S&P 500. I've been buying SCHD also in my Roth IRA, and I have another account where I'm building up a position in SPY. I invest for my kid also, and most of that is also going into a couple ETFs. One of them is SCHD. Now, notice one stock here had been cut fairly recently, and that was AT&T, ticker T. A few months ago, this was one of the most popular and discussed dividend stocks around. And after the Time Warner spinoff in 2022, the dividend was cut. And I sold out of that about a year before this for a slight loss, back in 2021, in another portfolio I own here in Robinhood. But I started buying back into it in this new portfolio last November at the lower price and this new dividend, which looks better to me after the cut. Now, we should get the next dividend announcement from AT&T in March, and we'll see what happens. Now, speaking of AT&T, my friend Russ with Dapper Dividends put out a great informative video about AT&T stock just recently, and if you're interested in learning more about AT&T, you should definitely check out his video after this one. I left a link in the description. And even if you aren't interested in AT&T or considering investing in it, Russ has a great channel. And I think if you like my stuff, you're going to like his stuff as well, naturally. All right, so let's finally talk about a prominent dividend company I think is at risk of cutting its dividend. Lots of strong opinions on this one. I'm talking about none other than Intel Corporation, ticker INTC. Intel is a semiconductor company. They design, develop, manufacture, and sell computing-related products. Their chips played an integral role in the rise of the personal computer. And Intel has been a popular dividend stock over the last few decades, but their business has taken a serious turn for the worse, and it's happening quick. Now, shares of Intel are down 40% over the last year. Revenue has dropped 20% in the last year from $79 billion in 2021 to $60 billion in 2022. This comes at a time when capital expenditures are up to all-time highs, over $25 billion in the last 12 months. Oh yeah, their current free cash flow is negative. Now, the current Intel dividend is yielding 5.03%. This is nearly 100% above its 5-year average. You like to see a stock yielding above its average, and I often use this when I'm looking for undervalued stocks. But you have to be careful. It's some of these that are getting so extreme that it's 100% above its average. To me, that triggers a red flag when it is that high. A secure dividend is one that is covered by free cash flow. Now, perhaps the negative free cash flow for this year is an outlier, hopefully, but the current dividend takes up about 300% of forward earnings. Another way to look at it, we have forward earnings of 50 cents per share, and the dividend is currently $1.46 per share. Here are the words of CEO Pat Gelsinger. "We are committed to the dividend and to a very healthy and competitive dividend." Now take that with a grain of salt. With their latest dividend announcement a few days back, they were on track to raise their dividend, but instead they maintained it. I don't know that they can do this for more than a few quarters without a substantial turnaround. Maybe things will improve, but forward guidance is not encouraging. They're projecting 10 to 11 million in revenue in the next quarter, and that's terrible. That would put them on track for 40 billion in revenue in 2023. That is a massive drop. That would be their worst year in 10 years. And their track record of meeting their guidance these last few quarters is not good. So for them to be projecting this low is really not a good sign. And negative earnings per share? Like almost every part of their business is down. This is an ugly time for Intel. PC sales have really slowed down. AMD has taken over a substantial part of their market share over the last 5 years. I don't own Intel. I do own some AMD. But look, if I was going to own Intel at this point, I wouldn't own it for the 5% yield. I would own it on the prospect of doubling or tripling my investment as a value play. But understand that with Intel, Another 50% drop is entirely possible. This is a risky play, no doubt. And when a stock drops 50%, you need it to go up 100% just to get your money back, just to break even. All you need to do is look at Intel's own history, and you'll see this stock still has never recovered from its highs in the dot-com bubble over 20 years ago. We don't know how these things are going to go, but I'm staying on the sidelines on this one. But I'll keep you updated because I know this is a popular stock. Many of you own it. Look, I just want you to be mindful of the risks in dividend investing, both to your capital and to your passive income stream. There are ways we can mitigate this, and I hope you found this video to be informative and give you some useful, helpful information on how to do that. Thanks for sticking around. If you're still here, please make sure you hit that like button for me. It really helps us out. Till next time, guys, keep investing. So I've been asked for ways to support the work we are doing on this channel, so I've created a couple ways you can do so. I am a single father who does this in my spare time, and I work full time. The first, I made an account at buymeacoffee.com where you can buy me a coffee as a way to support the channel, and you can find a link in the description. Personally, I'd rather use your money to buy dividend stocks, but if you want to support my work in this way, it is much appreciated. And second, much of the data here I get researching from the website Seeking Alpha, and I've partnered with them to bring you a wonderful offer for 50% off your first year of their premium membership. This comes out to about $12 a month, and I think it is a great value for all the information you're getting on Seeking Alpha, as well as all the excellent articles. This site is instrumental in my research to produce the content I do for you guys, and you can use the link in the description to get 50% off, and this is a great way to help support the channel. And finally, you can help me out tremendously for free by simply liking this video and making sure you are subscribed. Thanks again.